And as always, you guys are always free to ask questions. I don't like the word interrupt. Don't ever feel like you're interrupting me, because you guys are the reason that we're doing these live lectures, so that you can get your questions answered. Thamir and I were chatting before class started, and we were talking about how this chapter is going to change a lot of the way that we've been taught to think about inventory. And that's because the major change that you haven't seen in this chapter is due to the fact that we're now going to be using what's called a perpetual inventory. And perpetual, that word means ongoing or never ending. You talk about something, well, in estate planning, we talk about perpetuity, kind of means the same thing. You're planning out forever when you're looking at estate planning. So that's what I want to focus on today. I want to talk about mostly about the things that are different between this perpetual inventory system and what we were taught to do in Accounting 100, which was called the periodic inventory system. So I'm going to share my screen for a second, and let's go take a look at our schedule first. So you'll see that we have 3 chapters. Thank you very much. 3 chapters, chapters 4, 5, and 6 before we take our next exam. Chapter 4 is kind of a prelude to this massive inventory chapter that's coming. Chapter 5 is going to be the harder of the 3. So chapter 4 is preparing us for chapter 5. And then chapter 6 will be a review for you. It's going to be on cash. And the focus of chapter 6 is going to be on the bank rec. And you guys had a whole chapter. And if you had me for Accounting 100, you heard me emphasize the importance of a bank rec. So that's what's ahead. Chapters on inventory and cash. And what the author's doing is showing us the operating cycle of a small retailer. And then once he does that, he'll start going line item by line item through the balance sheet in later chapters. So that's where we're headed. Any questions on what's ahead? Okay, then our agenda is for the chapter in general. I didn't split it up between day 1 and day 2 because it just depends on how far we get today. So today we're going to be talking about merchandise operations. You guys are pretty well versed in what a merchandiser is because you spent the second half of Accounting 100 on merchandising. We're going to talk about some of the significant differences between the periodic system, which was Accounting 100, and the perpetual system, which is more commonly used today with the advent of fairly cheap computer systems and SKU tags. SKU tags are those things, I don't know if you guys have ever shopped at Home Depot, but I use Home Depot as an example because it's impossible to get out of Home Depot unless that little tag, SKU tag, it stands for stock keeping unit. I never knew that until I heard it on a TV show. SKU means stock keeping unit. It's the little barcode that tells Home Depot whether their inventory is getting low or not. So I don't know if you guys know what a perpetual inventory system means. I hope so after watching the video, but perpetual means ongoing. And basically in this chapter, we're going to track every in and every out. I'd probably put that in my notes. Perpetual inventory system means that we're going to track every in and every out. Well, how is that different from what we did last year? Last year in Accounting 100, we never touched the inventory account. The only time we touched the inventory account was one time at year end when a physical count was taken, and then we learned how to back into that big cost of goods sold adjustment. So we're going to be talking about how a perpetual inventory system means that every in and every out needs to be recorded. What the heck does that mean? It means when you see these big delivery trucks pulling up to the back of Home Depot, the inventory is going up once the inventory is delivered. And when you see those bright orange Home Depot bags going out the front door with customers because they're buying inventory and taking it out of the store, that's what's going to make inventory go down. So today we'll talk about the accounts used in buying and selling. And you guys will probably be familiar with all the accounts that we're going to talk about. I was telling Thamir, we were chatting a little bit before class started, that the purchases accounts are gone. I put a big X on my finger. Normally I'd write this on the board and put a big X through it. We're not using the purchasing accounts anymore. the purchase of inventory is going to be directly debited to the merchandise inventory account. I probably will still write that down in a minute. The last half of the chapter, we'll talk about the adjusting process, about preparing financials. And let me tell you this, based on this perpetual system, this income statement is actually going to be easier for us because cost of goods sold isn't going to be an account now. Last year, I don't know if you remember, you guys were tired. It was toward the end of chapters 12 and 13. We have that big old long cost of goods sold calculation. I mean, it might have been 9 or 10 lines long on coming up with that. That's gone now because cost of goods sold is going to actually be an account that we directly debit and credit. So it's nice to know where most of the things in Accounting 101 are more difficult than Accounting 100. The multi-step income statement is actually going to be easier because cost of goods sold will be known. And then when you guys come back next time, we'll also focus over those closing entries, which you already know how to do. So that won't be too bad. And as always, your author is sprinkling a couple of ratios in with each of the chapters so that when you get to Accounting 102 and you have that whole chapter on ratios, it won't be so overwhelming. And of course, at the bottom, we're going to spend a lot of our time practicing. So that's kind of our roadmap for today. Does anybody have any questions, or did you encounter anything in the chapter that confused you? Okay, then here's my handout. And by the way, all the files that we're looking at today are in the modules link. Okay, on the handouts, what I try and do is I try and take a look back, and then I try and take a look forward on how this chapter is going to help us make our way through this accounting journey. So we've looked at 3 chapters, which pretty much reviewed the accounting cycle for a service-oriented firm. And really, this first test that we took should have been mostly a review of Accounting 100. Again, since this is a university level transfer course, the author cranked up the level of difficulty by sometimes making us work backwards on some of these calculations. He focused a lot, and so did I on the exam. He focused a lot on equity changes because the corporate form of organization was new to us. So now we're going to make the transition to these merchandising operations. The good news is you guys had half of Accounting 100 devoted to merchandisers. So it's not the first time that we've talked about what a merchandiser does. The major difference is the difference in 2 inventory systems. One was a periodic system, which you used in Accounting 100, and that periodic system would be for a small, unsophisticated company that doesn't want to hassle with tracking all the ins and outs of inventory. So in Accounting 100, we learned that at least once a year, there had to be a physical count taken, and that's how we backed into cost of goods sold. The new part of this chapter, and looking ahead, is most companies, with the advent of fairly inexpensive accounting software and with the advent of fairly easy ways to track inventory movement, most companies now are using a perpetual-based inventory system. And that perpetual-based inventory system is going to track every in and every out. And so as opposed to last year, when we didn't use merchandise inventory at all, that account was, we put it up there for you and we told you it was an asset, but we didn't use it until the very end. That's changing. That account is going to be increased every time we receive inventory, and it's going to be decreased every time we sell inventory. And we'll take a look at that today. The author introduces you to the service firm income statement that we've been studying now for a few chapters. And then he notices or moves us over to a merchandiser's income statement. Here's the major difference in Accounting 100. Cost of goods sold now, you won't see a 10-line calculation. It's an actual account that we'll be debiting and crediting. So that income statement should actually be easier than the one that we learned in Accounting 100. Questions so far? Okay, so here are some issues that are going to come up. We know that the largest source of revenue for a merchandiser is sales. So when you are introduced to a new account, and it's not new for us because we've had Accounting 100, but in general, when you're introduced to a new account, you should know 3 things about each account. Sales is a revenue account. It goes on the income statement, and because it's a revenue, it normally has a credit balance. That's usually the largest revenue account of any merchandiser. So for example, I was looking at some things at Best Buy this weekend. If you go pull up the financial statements of Best Buy, and by the way, I'm a shareholder, so I often look at their financial statements, but their largest account on their income statement is going to be sales. Also, their largest expense is this cost of goods sold. And it's exactly what the name implies. It is the cost of those units that are sold. Sometimes it's called cost of sales. I think your book may refer to it sometimes as cost of merchandise sold. And we already know that the difference between that largest revenue and that largest expense is called gross profit. And we've also spent some time calculating the gross margin. On the balance sheet now is this massive account called merchandise inventory. So I know most of you have been into a Best Buy. You know, think about walking into a Best Buy. First time I walked into a Best Buy, I was completely overwhelmed. And I don't even know if Fry's Electronics is around anymore. But I remember also feeling overwhelmed when I walked into a Fry's Electronics because you could just see merchandise as far as you could see to the left and as far as you could see to the right. There was just millions of dollars of inventory on hand. And so merchandise inventory is one of the accounts, we'll learn this in chapter 5, where if you screw it up, if you screw up the accounting for merchandise inventory and you don't take an accurate physical count, all 3 financial statements are wrong for 2 years. You'll find that out in the next chapter. So in this chapter, he's going to introduce us to the basic journal entries for the buying and the selling of inventory. And if you think of your favorite merchandiser, any of them that you think of, I'm just thinking merchandisers that I've gone by in the past week or so. I'm thinking of the 99-cent store is one of my favorite merchandisers. And you guys that have me for 100 know that it's the only place as a single mom that I could let my kids go in and get whatever they wanted and not have to worry about it because it's the 99-cent store. But the 99-cent store and Best Buy and Home Depot and all those other places that we shop has the largest income statement account is sales, followed by cost of goods sold. And most of those, I don't know about the 99-cent store. I don't know what their accounting system is, but I do know that Best Buy and I do know that Home Depot have very sophisticated perpetual inventory systems. So if you've ever wondered, how does a computer know whether a certain inventory item's in stock? Home Depot knows exactly how many shovels they have at the Huntington Beach Home Depot, and they know exactly how many hoses they have because they have a very sophisticated inventory system that actually creates purchase orders when the counts get below what the company has decided they want to have on hand. How are they able to do that? By tracking every in and every out. So that's what we're talking about in this chapter. So let me take a breath for a second and see if you guys have any questions on anything you just heard. Okay, then all of these accounts should look familiar to you, right? Cost of merchandise sold is going to be a little bit different. So we'll pause when we get there. But sales, and again, as we're learning these accounts, I want you guys to think about creating a list of accounts. And I expect you to know 3 things: the type, the normal balance, and what financial statement it goes on. So I always have those 3 things in the back of my mind still when I take classes. Sales is the largest revenue account. Because it's a revenue account, it has a credit balance, and it usually is the largest item on an income statement. You can think of your favorite merchandiser and how they generate sales, right? The 99-cent store that I mentioned, they have voluminous sales of very small dollar items in the store. Places like Best Buy have sales, but much more valuable inventory. In other words, you're not going to get by buying anything in there for 99 cents. You're going to be spending hundreds, if not thousands of dollars on electronics equipment. Best Buy has really refocused their sales. They're a lot more into these home-based heating and cooling. There's a name for it. I can't think. The Nest, A lot more of the electronics and home improvements is what Best Buy has been focusing on. The Geek Squad has been upped. A lot more focus on getting technology installed into the home. They have a total tech support. I think it's about $200 a year, where they'll cover your electronics and fix your electronics and so forth. Those all go into sales. They might be different types of sales, but that's how a company like Best Buy earns their money. Sales returns, we know what those are. We've all probably been involved in a sales return or two when we purchased something and we didn't like it. If I buy something at Best Buy, a TV, and the picture doesn't seem as clear as I thought it should be, I can return it. Best Buy is going to record a sales return and allowance. Okay, sales discounts, we're used to those. We've recorded those. They're recorded exactly the same way. Sales discounts are those prompt payment discounts, those little fractions, 2, 10, net 30, where the 2 means they're going to offer you a 2% quick pay discount if you pay it within the 10 days. Sales discounts are recorded exactly the same as they've always been recorded. Here's a big new one. Cost of merchandise sold. That was not an account for us last year. It was a calculation for us last year. It's like 10 lines long. And that's because we were using this periodic system. Now we're making the switch. So I hope in your notes, as you were taking notes, as you were watching the video, now that's an account. It's an actual account. It's the largest expense account that a merchandiser has, will be directly debiting and sometimes crediting that account. The debit to that account will be every time we sell a good. Last semester, when we sold merchandise on account, all we did is we worried about the revenue. We debited accounts receivable and we credited sales. We didn't do anything to the inventory account. That's changing this year. Every time Home Depot makes a sale, there's 2 things recorded. The revenue's recorded like we're used to seeing, but the expense is also recorded. And the expense will be recorded, as we'll practice soon here, with the debit to this large expense account called cost of goods sold, and a credit to that asset account called merchandise inventory. And then I'll be putting a big merchandise inventory account on your screen today, and we'll have to adjust that for certain things. The other account that's totally changed in the way that we use it this semester is merchandise inventory. We were introduced to it in Accounting 100, but we didn't touch it at all until year end. Now it's the same asset account, but we are going to be adjusting it for every movement, every truck that pulls up to the back of the 99-cent store or to Home Depot is going to increase their inventory account. And every out means it's been sold usually. Every out is going to be credited to the merchandise inventory account. That's why we call it perpetual. Perpetual means ongoing. And here's an account that's gone away. We used to use freight in or transportation in. Now in this chapter, your author is going to replace that with merchandise inventory. Why? Because if you think about it, the cost of the shipping really should be part of that inventory. In other words, think about a pair of shoes that you might buy online. If you have to pay, let's say you paid $50 for the shoes and the freight costs you another $5, the cost of those shoes to you, using the cost principle, is $55. And so what we're going to be doing is we're going to be wrapping that transportation account into merchandise inventory account. Anytime that we are the buyer and we buy something for FOB shipping, and we'll practice this in a little bit, you're not using the freight in account anymore. You're going to be using merchandise inventory. Okay, so get that into your notes. Transportation in costs make the merchandise inventory account go up. And part of the confusion of this chapter are these freight terms. And if it confuses you in chapter 4, it's really going to give you some counting challenges when we get to chapter 5 on inventory. So we're going to do an exercise just on transportation costs in a minute here. And by the way, FOB shipping is the most common shipping form. That is where buyer pays the freight. And I know that for some of us that are in Amazon, the Amazon age, and we have like Prime accounts, we don't pay shipping because that's an Amazon thing. It's not a normal merchandiser transaction. Most of the time in merchandising, the buyer pays the freight, and that's called FOB shipping. On the rare occasion where the seller pays the freight, that's going to be FOB destination. I would say that happens between 5 to 10% of the time. And that's where the seller is responsible for the costs. Well, the other reason that those FOB terms have such importance is because that also determines who legally owns the inventory at the time it's shipped. Okay, that's important. It's going to become extremely important in the next chapter. So if it's FOB shipping, as soon as it leaves the seller's dock, it's the buyer's. That's what FOB shipping means. FOB destination, the less common of the two, the legal title remains with the seller until the goods are actually delivered. And so again, that's going to have implications for this chapter. We're going to do an exercise here in a minute related to that. It's also going to have implications for the next chapter where we're going to be counting and costing inventory. And so then I just kind of reviewed some of the basic transactions of, remember, under the perpetual inventory, no more purchases. Okay, so I'm going to get a Word document up here because I want to make sure that you guys understand what's happening with the perpetual inventory system because it's new. We're going to track every in and we're going to track every out. And that means that we will no longer be using all these purchases accounts. All those purchases accounts that you learned last year, they're gone. In place, we're going to use merchandise inventory. So purchases is gone. Purchases, returns, and allowances is gone. We won't be using it anymore. Purchases, discounts is gone. We won't be using it anymore. And freight in is gone. We won't be using it anymore. So all those accounts that you learned about in a periodic system, they're all gone because what it's going to be replaced by, it's going to be replaced by merchandise inventory. So all those things that we just crossed out here are now going to be making that inventory account either go up or go down. That's the major difference between a perpetual system, which we're using in this class, and a periodic system, which is what you used in Accounting 100 class. So let me stop, see if you guys have any questions. Okay, let me go back to that handout and look at a couple. Oops, where did it go? So to buy merchandise inventory, again, I want you guys to picture yourselves in your favorite merchandiser. So for me, I'd be thinking of the 99-cent store. And what would cause the merchandise to go up there when the trucks pull up to the back and they're offloading the merchandise inventory? And I don't know what type of inventory system the 99-cent store has because I haven't had the chance to ask or walk over there. I often do that a lot. People think I'm strange, but I often will talk to managers about their accounting systems. So merchandise inventory is going up when they buy it. And if they are offered an early payment discount, notice that purchase returns is gone. We're not doing that anymore. That was one of those accounts that we crossed out. Instead, the cost of our inventory would go down. Why? Because you didn't pay as much as you recorded it for. In other words, if we bought that inventory for $100 and we wound up paying $98 because we were offered a 2% discount, that inventory should be on the books for $98, not for the initial $100 we paid. So here's the journal entry to buy it. Here's the journal entry for that prompt payment. We're using the gross method, by the way. There is a new accounting pronouncement out, revenue recognition principle, which makes you convert to a net. Those of you that are accounting majors can read about it in the appendix. But for our purposes right now, the adjustment's usually very small and we're not going to worry about it. And then if we have to return the inventory to the vendor, That makes sense. The inventory would go down. Okay, other issues. You heard me mention this. This is a source of great confusion, so I want it in your notes. And that is title to the inventory. That's why these freight terms are important. And FOB either stands for free on board. I've also seen it in textbooks as freight on board. But the important thing is it determines ownership and it determines who pays, right? FOB shipping is the most common. We said probably 90 to 95%. The goods are the buyers as soon as it leaves that shipper's dock. So it may not be in your physical custody yet, but it's yours. And what that means is that needs to be included in the inventory counts that'll come in the next chapter. That's what happens most of the time. Some sales, probably 5 to 10% of the sales, are FOB destination, which means seller pays the shipping, and seller, whoever pays the shipping, bears the risk of loss. And what that means is title stays with the seller throughout the whole transit process until it's actually delivered to the buyer. And because it is a seller's cost, we use a seller's expense, delivery expense. Okay, so here's what throws students in their notes, or I want you to get it in your notes. FOB destination, you will never use the merchandise inventory account for shipping. It's going to be delivery expense. So if you're the seller, you use delivery expense. Okay, some companies use transportation out. Same account, different name. We know this from Accounting 100. You cannot take a prompt discount on freight costs because it's usually paid to another company. And we're going to practice calculating the amounts. That's the buying side of the house. Any questions on that? We'll practice mostly the buying side today. We will touch the sales side. The sales side of the house, here's the new part right here. We're used to putting the accounts receivable and sales on the books. We're used to that from Accounting 100. That's what we did in a perpetual periodic system. But now that we're tracking all the ins and all the outs, we also need to get the expense portion on the books. So every time you make a sale now, get this into your notes, there's 2 journal entries under a perpetual system. There's the revenue side of the house to put the revenue on the books. And at the same time, you put the matching expense on the books for whatever the cost of that inventory is. That's the new part on the sales side of the house. And any type of discounts or returns are going to be handled pretty much the same way that you've been doing them. We're used to seeing sales discounts. Those are still intact. And we're used to seeing sales returns. But the difference with the perpetual inventory system now is got the revenues. That's not a problem. You also got to remember to take the expense off the books if you're returning something. Okay, so that's sales returns. And then the shrinkage adjustment we'll work more on next time. So I think, pending any questions, which of course I'd be happy to answer, I think for the rest of the class today, we're going to get our hands dirty after half an hour kind of summary lecture of what you should have watched in the video. We're going to jump in and get our hands dirty and practice what we just talked about. So does anybody have any questions on the lecture portion or anything that you watched in the video or that possibly came up during your reading? Any questions you guys want to ask? All right, then I'm going to move to the Excel file. So we're going to start off with just basic buying transaction. So again, think of your favorite merchandiser and think about the buying side of the house. That's what we're going to focus on first. Remember, we are using a perpetual system. That means we expect to track every in and every out. And we're using the gross method, which is the same method that you guys learned about in Accounting 100. So let's do journal entries, get some practice here. Remember, no more purchases accounts, nothing related to the purchases accounts. So if you catch yourself using purchases, or purchases discounts or freight in or any of those purchase related accounts, you got to catch yourself. We don't have those anymore. They're all going to be run through the merchandise inventory account. So I think we're ready to go. It says we bought 4,600 of merchandise from Lion Company with terms of 215 net 60. Okay, again, to refresh your memory, that means that we can take a 2% discount if we pay it within 15 days. Otherwise, the whole thing's due in 60. And the terms are the typical terms, FOB shipping. That means the buyer's going to pay the freight. So let's date this. I'm going to do April 2nd. And to keep that from coming out funky, you may want to put a space in front of the April. I think I'll do that. Otherwise, Excel will put it in a date mode. So again, if you put a space in front of whatever you're typing in, Excel won't put it in that weird date mode. And we bought $4,600 worth of merchandise. So here's this new account that we're going to start using a lot now called merchandise inventory. That would be at the gross amount of $4,600 because we don't know whether we're going to be able to take that prompt payment discount right now. And of course, because we owe somebody money, we bought it on terms of 215 net 60. We owe accounts payable Lion Company $4,600. And even though Connect does not ask you to put in these third line descriptions because it has no way of checking to see whether they're accurate, I'm going to go ahead and create good habits and always write down what the terms of this are. And in this, I would include any source documents. Remember what the journal is. The journal is an economic diary, daily diary of what happened economically to this company. So we want to leave good records. They didn't give us any kind of invoice number, but if they would have, always create good habits by writing down source documents. And then what I would get into the habit of doing, because I think it's going to make your life easier, I would keep little T accounts because pretty soon it will start to become a little bit more confusing when either you owe somebody money or somebody owes you money, because you guys are introductory students right now. So right now I'm going to come up here and put AP for Lion. And right now, if I were to write a check, I would owe them $4,600 less any kind of discounts. So I'm going to just, as a matter of good habits and knowing that we are students and we're still learning the ropes here, I would create T accounts for anyone that you owe money to or anyone that owes us money accounts receivable wise. And that'll make life easier on the subsequent payments or receipts of cash. Okay, if you have any questions, go ahead and just ask away. Don't sit there and wait until the end. I'd much rather have your good questions as we go. All right, April 3rd, paid $300 cash for the shipping charges. Last year, we would have used freight in, but we don't have that account anymore. We don't have anything related to the purchasing side of the house. So instead, we just increased the amount of inventory because it costs us some money to get it to us. That's following the cost principle. Our cost for that inventory just went up by $300. Okay, good description, paid freight costs for April 2nd purchase. Now, how did I know to use merchandise inventory and not that delivery expense? Okay, how would I know? The terms there were FOB shipping, right? When it's FOB shipping, that means buyer pays the freight. I hope that's in your notes because that can cause trouble in both this chapter and the next chapter if there's not a clear understanding of how those freight costs work. Okay, and that didn't affect accounts payable, so I don't have to worry about updating my T account. April 4th then. If I don't hear any questions, I'm going to keep going. If you do have questions, go ahead and ask. Okay, we returned to Lion some unacceptable merchandise that had an invoice price of $600. Okay, so if we're returning some stuff to him and we haven't yet paid for it, then our accounts payable is going to go down because, of course, if we return something, we're not going to pay somebody for it. So that transaction is going to be a debit to accounts payable for Lion because our debt is going down and our inventory went down because we are returning some goods that for some reason, maybe it's the quality, maybe it's the color, I'm not sure what they bought, but for some reason it's not acceptable to us. And so we're going to take a $600, not $6,000, $600 amount off our bill when we pay it. So I'm going to come up here to accounts payable and I'm going to put in that $600 and I'm going to remind myself what that was. That was a return on April 4. I'm just updating my little T account here because probably what's going to happen in a minute, we're going to return this stuff or we're going to pay for it actually. So any questions on the second, third, or fourth?
Yes, Professor. For April 2nd and April 3rd, if those two were consolidated into one transaction, it would still be it would still need two separate journal entries to report it, right?
You could do it in one. It is possible to do it in one. If they would have said all at the same time, we could have debited merchandise inventory for $4,900, Demir, the whole thing. And we could have a credit to AP for the $4,600 and a credit to cash for whatever check we gave to the UPS guy.
Okay, all right.
Yeah.
And also, if a company were to do an audit on the merchandiser and they see that merchandise inventory is being credited, would that signify to them that it was either a purchase discount or like return and allowance?
Yeah, it should be supported by some type of a document. In this case, it would be a credit memo from the seller confirming that they received our goods that we shipped back to them.
Okay, all righty.
Unfortunately, they didn't give us enough information about the source document to list it here, but that's a very good question.
All righty, thank you.
You're welcome. Okay, so now on the 17th, I think we're ready to pay them. So what I'm going to do is go over to my T account here that I'm keeping track of because, again, we're learning. And I'm going to foot this T account right now with no discounts considered. I owe them $4,000. So now that we are getting ready to pay them, we have to ask ourselves, can we take a discount? Well, going to the original terms, it was 2% if you pay within 15 days. Okay, we are actually paying on the 15th day. So we are eligible to take a discount. Okay, there is no freight in here. I don't have to worry about not being able to take that discount on the freight. Remember, the freight was paid for separately here. So using these terms, this 2%, if I pay within 15 days, I am eligible to take the discount. So I guess I should have put a better description here. I got involved with the Demir's question and forgot. So returned unsatisfactory merchandise. Let me get that updated here. And then when we pay this on the 17th, here's what's going to happen. Our debt for accounts payable is going to go down. Okay, we're looking at that T account. So I'm going to take out the whole $4,000 because I don't owe Lion any more money. So I am eligible to take the discount, not on the $4,600 because I returned some of it, but on the $4,000. And those terms tell me that I can take a 2% discount. Now, last semester, you would have used purchases discounts. But remember, all the purchases accounts are gone now. In place of that, we're using merchandise inventory, and that would be for the 2%. So over here, let me do the math, 4,000. I guess I better put an equal sign if I want Excel to do the math. 4,000 times 2% would be $80. And that means I need to fork over cash of the difference. So I'll put the calculation there. Didn't have to worry about them throwing us a little curveball with freight costs that were involved. And that ends the operating cycle on that transaction to pay for merchandise purchased on April 2nd, less the return and less the discount for your notes. I want to leave a really good description. And if I were to look at this T account now, it is completely zeroed out. One other thing I would encourage you guys to do, just as you're learning, take a look at what's sitting in the merchandise inventory account, right? Because that's the new part of this. If I go back, and normally I wouldn't do this in class, but I think it's important as we're learning about this new perpetual system. Let me make a real quick account just to give you an idea of what's going on here in this merchandise inventory account. Remember that merchandise inventory is an asset. In other words, it looks like this, like all assets look. And let's see what's in the merchandise inventory. So I'm going through these and I'm going to post anything that affects merchandise inventory. Okay, here was the purchase. And here was some freight. What I'm doing is creating an inventory account that's going to help us later, probably in the next class, actually. Here is a return. This was a purchase return that made the inventory go down. And here is that discount, that $80 discount. If I were to foot this, this would be how much is sitting in the inventory account. What was the cost of all the inventory that you bought prior to that transaction? Let's add them up. I'm going to add up the left, and then I'll take out the right minus the sum. Hopefully I did that math right. Let me get my calculator out because I'm not sure if I blew the Excel thing really quick. 4220 is right. That's how much I've spent net on that inventory. That includes the cost of the inventory. That includes the freight. That includes the fact that I returned part of it because I didn't like it. And that includes that discount that I took. So there's what's sitting in the merchandise inventory account right now. This is a big change from Accounting 100 because we didn't touch this account last semester at all until the end of the year when we made an adjustment to it. And last year we had to calculate cost of goods sold. This year, once we start dealing with some sales, cost of goods sold is an actual account. Why didn't we use cost of goods sold in this one? Because these were buying transactions only. Any questions on that? All right. Here's what I remember throwing students for a loop in a prior edition of the book. This is actually a new problem they added. And I'm glad they added it because the transportation issue becomes a problem with students. It becomes a major issue in the inventory chapter as well. So I'm glad that they finally put one of these in here. So here's what it says. And out of all the transactions we're doing today, this short one, I think, will cause the most problems. So it says for each transaction of Sealy, they want you to determine whether or not Sealy owns the goods during transit. Transit means while it's on the UPS or the Amazon truck, right? That's what transit is. So we're going to do two things. We're going to determine if Sealy owns the goods. And if Sealy does own the goods, or if Sealy is responsible for the transportation, what would the journal entry mean? Okay, or be. So let me put a couple transactions down here. I will widen my formula or my column so you guys can see that. So I have 4 transactions down here. I don't think we need the decimals on that. So let me get rid of those. Here's what I'm going to answer. Does Sealy own the goods during transit? Because that was one of the questions. And what is the journal entry if there is one? Okay, so again, I would star this problem because I think there's going to be multiple choice questions on both chapters 4 and 5 that will throw you for a loop if you don't understand who legally owns the goods. So number 1 says, Sealy purchased the goods, FOB shipping point. Okay, stop. What does that mean? Okay, FOB shipping, I'm going to write this down. FOB shipping means buyer pays the freight. That means the buyer owns the goods. So I'm going to read it again. Sealy is the buyer. They purchase goods, FOB shipping. Transportation costs are $600. Okay, what does FOB shipping mean? You are paying the freight. You, the buyer, are paying the freight. That means it's yours as soon as it leaves the seller's stock. So do they own it? The answer is yes. Okay, so let me get that in there. Yes, they own it. If they own it, there has to be a journal entry for that cost. So if I'm the buyer and I'm the one paying the freight, the journal entry is a debit to merchandise inventory and a credit to cash. So let me put the debit and credit in here. In fact, I think I'll move this up so I can use 2 lines. Merchandise inventory and cash, and that would be for the transportation costs of $600. So you want to ask yourself this question on an exam as you're doing the homework: who owns the goods? FOB shipping means buyer. It's the buyers. As soon as it leaves the seller's stock, the buyer has the risk of loss. The buyer owns the goods. The buyer would make this journal entry. Okay, now remember, whatever merchandiser you think of in your head, for me, it's 99-cent store. For somebody else, it might be Best Buy. For somebody else, it might be Vons, right? But think about this. Every single company that we just mentioned, they do things on both sides of the house. They buy it and they sell it at a markup. They buy it and they sell it at a markup. All merchandisers have buying and selling transactions. So number 2 says, Sealy is now the seller. Sealy sold goods, FOB destination. Okay, let me write down what FOB destination means. The seller owns the goods until they are delivered to the buyer. So since Sealy is now the seller and the terms were FOB destination, does Sealy own the goods? The answer is yes. They are the seller and the title remains with them until it's delivered. Remember, when you're the seller, you don't use merchandise inventory for the freight. You use that expense account, delivery expense. 200. Okay, let me stop, because this can get a little bit more complicated for both this chapter and the next one. Any questions on those first 2?
Yes, Professor. Can the shipping be also paid by accounts payable?
Yes, it could be. If you had a running account with, let's say, I have a running account with FedEx, right? They can charge it to the account. So it could be accounts payable. The mirror, what it says is assuming they are paid in cash. That's why I'm using cash, but it could be accounts payable if you have an open account.
What if you have an agreement with a company that you don't pay the shipping at all, because you have an agreement, say, with a company that you pay a one-time fee and it's kind of like a prepaid expense where it covers that month of shipping costs?
Yeah, that's a revenue recognition principle, and you would have to allocate that across the time period that agreement is good for. That creates some difficult accounting issues that we won't be covering, but it's a great question.
Okay.
Revenue recognition principles. Yeah,
Okay.
they would have to prorate it over the year.
Oh, okay. Yeah. So like a prepaid expense almost, right?
Almost, yeah.
All righty.
Okay, good question, as usual. Okay, here we go again. Sealy sold. Okay, stop. Sealy is now the seller because it said Sealy sold. So they are the seller. They sold the goods FOB shipping. Okay, what does FOB shipping mean? FOB shipping means buyer pays the freight. The buyer right now owns the goods. So buyer owns the goods. Sealy does not own them because he is the seller. And therefore, because the shipping is not his problem, there will be no journal entry on that one. The buyer owns the goods as soon as it leaves the shipper's dock. That same one on number 1, that same explanation. The buyer owns the goods, and right now, Sealy is the seller. Okay, now last one, unless you guys have a question on 3. Sealy purchased, okay, stop. Now we're the buyer. Now Sealy is buying goods. Sealy purchased goods, FOB destination. Okay, FOB destination, remember, means seller pays the goods. So I'm going to write that in again. FOB destination means seller pays the freight. They own the goods and they maintain ownership of that until it is delivered. So while they are in transit, Sealy is the buyer. There is no freight issue on the buyer side. So no freight costs on the buying side, and Sealy is the buyer. So that means no, Sealy does not own the goods. That would stay with the seller, and there would be no journal entry. Now, if that seems confusing, it is one of those cutoff issues that we're always looking for on audits. I have quite a few people that are interested in going into public accounting. And as a beginning auditor, one of the things you'll be looking at is those cutoff dates. If they have, for example, a 12/31 year end, you'll be looking at receipts of goods that happen shortly before and shortly after, and you'll have to determine whether the company should have included it in their inventory costs, because inventory can be yours even if it's not physically in the building. And when we move on to chapter 5, you're going to learn there's 2 issues with inventory, the counting and the costing, and they go hand in hand with each other. So this question's really important for those reasons. And it's out of the 4 or 5 we're demonstrating in class today, I think it will create the most challenges for you on your homework. And don't just guess on your homework. Sometimes we get so focused on, oh, I just need the points. You know, you click down the drop down button for yes. And if it doesn't work, you press no and you go on. I want you thinking about why you didn't get it right the first time, because that little check your work button is not going to be there on the test. Questions on that? Okay, 4-9, I like this one because we're going to look at transactions from both sides of the house. And if you had me for Accounting 100, you saw me describe this as the mirroring effect. In other words, if there's an accounts payable on the buyer's books, there has to be a related accounts receivable on the seller's books. They're going to mirror each other. And so that's why I'm going to do this one side by side. In Connect, you'll be doing it vertically. I'm going to present this side by side so you guys can see that mirroring effect happen. So give me a second to pull that one up, and let's go ahead and work through this one. It says Santa Fe Retailing purchased merchandise from Mesa Wholesaler. So the first thing that I like to do in these is determine who's the buyer and who's the seller. So Santa Fe Retailing purchased, okay, they are the buyer. So I'm going to write that down. Merchandise from Mesa. Mesa is the one doing the selling with credit terms of 3/10 net 60. What the heck does that mean? It means if you pay this within 10 days, you can take a prompt payment discount of 3% that's offered to you by the seller. And the invoice price was $24,000. The merchandise had cost Mesa $16,000. Okay, of course, the buyer's not aware of what the merchandise cost you. It's none of their business. They wouldn't know that. Assume that both the buyer and the seller use that perpetual inventory system, which is the focus of the next 2 chapters, and they use the gross method. Okay, so first one, prepare the entries for the purchase, the cash payment within the discount period, and the cash payment after the discount period. Okay, so let me take the decimals off that first line. So now we are the buyer. What's the buyer going to do? Well, if we weren't careful and we were used to last semester, we may say purchases. Okay, but wait a second, that's a periodic system. We don't have any of those purchasing accounts anymore. We're perpetually updating the inventory accounts. That means every in is going to pull the merchandise up and every out is going to pull the merchandise down. So what we're doing here is we are increasing, we're the buyer, our merchandise inventory, and we're also increasing our debt because they sold it to us on account. And this would be to Mesa wholesalers. I'll just put Mesa for what they sold it to us at, $24,000. Okay, there's Mesa's entry. We're going to do the same thing on number 2 from the other side of the house. What's the seller going to be doing that sold that to us? This is what I mean about this mirroring effect. On the seller side, he has or she has an accounts receivable on their books for that $24,000. And the seller now, this is new, has to do 2 journal entries. They need to put the revenue on the books. That's what we did last year. But they have a second requirement. They also need to put the related expense on the books because GAAP says you need to match up the revenues and the expenses in the same period. So there is their matching transaction that records the revenue. Here's the new part. The expense also has to be recorded. So we're going to use COGS or cost of goods sold. And because we're selling the merchandise, our merchandise inventory needs to go down by the cost of that merchandise. And they would have to disclose to you what that is. It was $16,000. And here's the other great thing about a perpetual inventory system. Every time somebody walks out of Home Depot holding one of those bright orange bags, Home Depot knows exactly how much gross profit is in that bag. Why? Because, for example, on this transaction, they know that the gross profit, don't forget, is the difference between the sales and the cost of goods sold. So when they watch that orange bag go out the door, if you're Home Depot, they know that 24,000 of sales were in that bag and 16,000 of expense were in that bag. They know that there's 8,000 in profit walking out the door on that crate, walking out the Home Depot door. What does that allow them to do? It allows them to track at any moment in time. They know what their gross profit is. And because it's going to come up in this book again, we've been doing this, but we should also be able to calculate the gross profit margin, right? And that gross profit margin right there would be that gross profit of 8,000 divided by 24,000. That's going to be 33.33%. I always found it fascinating when I didn't understand what perpetual systems do. I would always find it fascinating that someone can tell you exactly how many shovels they have at any given point in time. In fact, if I were to go online shopping and I wanted to buy a refrigerator, they would know whether that exact refrigerator that I wanted was in stock because they track every in and they track every out. So there's the original sale. Okay, the second part of that, let's see, they wanted the purchase. They want the cash payment within the discount period. So number 2 is saying, what is the payment if it was made within the discount period? Okay, well, remember the terms, I'll go write them down here, were 310 net 60. So if I make that payment within the discount period, I'm going to get rid of, if I'm the buyer over here, I'm going to get rid of my accounts payable, the whole thing, 24,000. But I'm able to take a discount. Okay, last year we would have called it purchases discount, but those accounts are gone. Nothing related to purchases exists anymore. Instead, we're going to use merchandise inventory, and the way I would calculate that is 24,000 at 3%. So let me let the computer do that. 720 is my discount, and that means I would fork over cash, which would be equivalent to the difference between those two. And I'll let the computer do that. And that would be to pay off amount owed within the discount period. Okay, what would the seller, the one that's receiving the cash, what would he or she do? Again, these are going to mirror each other. If they're giving me cash, either via check or through some type of automatic payment, then you're going to be debiting cash. Let me move that out of the way. You're going to be debiting cash for the same amount, because of course you're getting their check or their payment. And just like you did last year, we're still going to have a sales discount. And again, these accounts receivable and accounts payable mirror each other. So again, I'm going to write arrows in. They mirror each other. Yeah.
I just wanted to point out if you can move the sales discounts over to the like the debit side.
Yes, thank you very much. That would have been confusing to me as well. And you notice how these are mirroring each other too, right? Which makes sense. One of them is reducing the cost of the inventory because they didn't pay as much as they thought. The other one is being recorded in a contra revenue account that's going to wind up pulling sales down. And what that would also do, those of you that are perceptive enough to see this, what that would do is that would reduce that gross profit margin, right? Because our net sales would be decreased because of the fact that we offered that prompt payment discount. So companies always have to weigh, is it worth it for us to offer that 3% discount? Companies that want their cash in really quick, it's worth it. Other people may say, well, you know what? Maybe we shouldn't offer that prompt payment discount. Questions on that one? I like that one because it shows transactions from both sides of the house. So the new parts on here, we didn't use merchandise inventory at all. That was a non-used account last semester, except for at the very end of the year where we made an inventory adjustment to take out the old and put in the new. That's how we taught it in Accounting 100. Now we're using a more sophisticated inventory system, what the majority of companies these days use, unless you're looking at a little corner store owned by a mom and pop, then maybe not. But most small to large size companies use a perpetual inventory system for many different reasons. It allows them to control their inventory better. It allows them to track their inventory better. It allows them to know at all times whether their company is remaining profitable in terms of the gross profit margin. Well, 4-2B is more of the same. I think I've demonstrated to you most of the concepts that are going to fall under this category. So what I think I'll do on this one, let's see, purchase sold. So I will send the answer out today. And then what I would like for you guys to do, this would be a great problem to test your knowledge of the chapter. I would try this one on my own, maybe during the extra class time we'll have left. And then I would go compare it to the answers that I'm going to post shortly. And if you're able to get the vast majority of these correct, you have this chapter down. And if you miss a bunch, say you miss 3 or more, 3 or 4, then you got a little bit more studying to do. And of course, I'm available to answer any questions anytime they come up. I just don't want to make this a big, monotonous, boring class with me spending lots of times on journal entries that I've already demonstrated to you. Yeah, I don't. So my advice to you on this one would be to do just what we did on that previous question. I'd be keeping T accounts for accounts payable and accounts receivable. I think that will help you wade through the monotony.
Professor, because the shipping is included in the same, I guess, the same sentence, would it be safe to say that we can just include it in the single journal entry in the homework, or?
Samir, I'm pretty sure that your author is going to do it in two journal entries.
Okay, all
right.
right.
So for example, let's just take this first one. Freight always confuses students. So I'm going to go right to the freight. This is FOB destination. That means, and again, in your head should pop up, okay, seller's going to pay the freight. Seller's going to pay the freight. Well, here we're the buyer. So that destination, we won't expect any shipping on that. So this one's just going to be a debit to merchandise inventory and a credit to accounts payable. Let's look at the next one, where this time we're the seller. I think this might be the one that you're asking about. Sold merchandise, and here it's FOB destination. Okay, now we're the seller, and FOB destination means it's our cost as the seller. And you might be looking for the freight, right? I don't see it in there. That means it's going to probably be paid later. And here it is. Here's that shipping cost. So it's going to be done separately. This is going to be that delivery expense here. And up here, there will be no shipping costs involved because it's paid later and it's the seller's expense. Hope that helps answer that question.
Yes, it does. Thank you so much.
You're welcome. Anybody else see anything in there that we haven't talked about that you're like, oh, I'd like to see that demonstrated? Okay, then let's go to this last one because it involves some ratios. And let's go over these ratios. These are all, I'm looking at them, they are all a repeat from Accounting 100, but because it's been a while since you may have taken Accounting 100, let's go over these. So I want to get into your notes what these things are and what they measure. And then we'll answer the question, overstated, understated, or no effect. Okay. And this will become more clear in our second session when we talk about inventory errors. Remember what I said, though, this is coming up in chapter 5. Inventory errors affect all 3 financial statements for 2 years. And you might be saying, well, why for 2 years? The ending inventory of one period becomes the beginning inventory of the next period. And so there is an error going opposite ways in both years. We'll focus more on that next time, but let's get these ratios into our vocabulary. The gross margin ratio. We already know what this one is, but we'll get it into our notes. This is calculated as the gross profit on the top, which in case you've forgotten what that is, sales less cost of goods sold, divided by the net sales on the bottom. And let me fix that. And this is a measure of how profitable the company is just on selling the goods. And again, you've heard me mention Shark Tank. I had to laugh because I don't watch TV, but my husband, to be nice, he was trying to get me to relax and just watch some nonsense stuff. So he knew that I'd like the Shark Tank. So he went this weekend and recorded 2 or 3 of the newer ones. And what was so funny is he was getting into this show, and he doesn't know anything about accounting. He was getting into this show more than I was, and was referring to Mr. Wonderful and all the celebrities, the entrepreneurs that play on that show. And again, the sharks aren't even interested unless your margins are 50% or higher. In the United States, they need to be around 38 to 40% for a company to maintain profitability. Okay, so indicate whether the failure to include an in-transit inventory part, okay, that means in English, that means failure to include inventory. That means that your inventory is understated. Okay, that's what that means. You forgot to include an in-transit inventory part. If inventory is understated, that means that cost of goods sold is always the opposite, is overstated. They always go opposite, inventory and cost of goods sold. If one's under, the other one's automatically over. We'll talk more about that in chapter 5. And if cost of goods sold is too high, that means the gross profit will be too low. This is one of those questions that makes your brain scramble. It's not one that I can answer off the cuff. I have to think about what's going on, right? I know from being an accounting person that inventory and cost of goods sold, they always are the opposite of each other. There's this one bucket. If something goes into the bucket, it's going to come out at one or the other. They're always opposite. So not including that inventory that might be in transit, but you own, would include a gross profit misstatement. Your gross profit would be too low. Is that easy? No, you have to think through the transaction. And again, it will become more apparent in chapter 5. Okay, profit margin is going to be exactly the same. The profit margin ratio, the effect's going to be the same. Profit margin is net profit, net income. So that's the difference. Instead of having gross profit on the top, you're going to have net profit on the top and net sales below. And because they're both measuring profit, the effect is exactly the same. So I'm going to put exactly the same as A.
Professor, is this primarily because of the deduction of the ending inventory, like you said?
It mostly has to do with the fact, let me see it. This is going to become much clearer. We're going to talk about inventory being a bucket of stuff that you buy. And if I spend, let's say I'm making up a number, Thamir, 5,000 on all this inventory, it's going to wind up in one of two places. If it's sold, it's going to wind up in cost of goods sold. And if it's not sold, it's going to wind up in ending inventory. Right? So here's what I mean. I'm pulling the number out of the air. If I bought $5,000 worth of stuff and I sold 3,000 of it, the rest of it's going to be over here. Has to be 2,000. It's going to wind up in one place or the other. So if this is understated, right? If this is, they didn't count those last 200 that came in, by default, then this is going to go the opposite way. This is going to be 2,200. It has to balance to 5,000 every single time. That's
Right.
what I mean about them being the opposite effect.
Okay. Thank you so much.
Yeah, and it's going to come up more clearly when we do chapter 5. I kind of wish they would have waited to ask this question in chapter 5. Okay, any questions on the difference between a gross margin and a profit margin? One is gross profit, just the profit on the goods that you sold. And the net income or the net profit is the last line of your income statements. It's after all the expenses are considered. All right, then let's see if you guys can remember acid test. And actually, I think they called this a different name in Accounting 100. I think this one was referred to as the quick ratio. Same thing. It's like half a dozen or 6. It means the same thing, just a different name. So this is what we call a cream of the crop liquidity ratio. And what that acid test did is it took the three most liquid assets that somebody could have, which is cash, marketable securities, those would be things like stocks and so forth, and accounts receivable. Those are the three most liquid assets a company can have. And it sees what percentage that makes up of the current liabilities. Okay, you might be thinking, and I'm going to go to D also because they go hand in hand. I would have given you the current ratio first. The current ratio is all the current assets divided by all the current liabilities. So that is one that you learn toward the beginning of Accounting 100. We talk about it several times. And the goal on the current ratio is to be 2 to 1. And what that means is, I didn't mean to write it that way. What that means to you or to someone looking at ratios is that for every dollar in current debt, a company has $2 in current assets with which to pay it off. The acid test that you see is even more stringent. It doesn't look at all the current assets. It just looks at the cream of the crop current assets. And what a bank likes to see in this one is 1 to 1, which means for every dollar of current debt, a company has a matching $1 of really liquid assets with which to pay it off. So what they're going to ask you here is, what effect does the inventory error, what effect would that have on this ratio? Well, I don't know about you guys, but as I'm looking at this acid test or this quick ratio, there is no inventory in there. There is no inventory on the top or the bottom. And so this one actually has no effect because inventory doesn't appear on either the top or the bottom. So no effect. If you make a misstatement, your acid test ratio is not going to be affected. Now, will that change with this last one? The answer is yes, because unlike that acid test, this is all the current assets. So inventory would be in the numerator on this one because it's part of a current asset. And it would be understated if ending inventory is not included. So that one's not easy. That one makes you think through the accounting equation and how having one mistake can drop down to another. This one will become more clear in chapter 5. Again, I kind of wish they would have waited, but I thought, you know what, I'm going to put this in their notes now so they can start thinking through it. And what I hope to do is come back to this problem or exercise in chapter 5, and I think the light will come on once we talk about counting and costing in chapter 5. That is the bulk of the chapter that I wanted to cover today. So here's what I would do to ask myself, self-assess, which is something that I'm very interested in, not just as a teacher. Of course, I'm interested in you self-assessing yourself, but also as a learner. When I take classes, I'm very interested in, do I get this material? Have I studied enough? Or do I need to go back and hit the grindstone and remedy some weaknesses? So the way that I would answer that question is I would go home and try this problem in the 30 minutes of class time that we would have left. And then I'm going to go post the answer as soon as Julie posts her file. I'm going to go post the answer, and I would use this question to self-assess yourself. And if you miss any of them, send me an email on why is my answer wrong, or I thought it was this. Can you explain why it's not? And again, remember, I'm in my office every morning before class. I did have a busy office hour this morning, but usually it's pretty quiet. You can always come in and ask me questions then as well.